So chapter 15, we're talking about S corporations now. This is one of my favorite things as far as business is concerned, is operating as an S corporation instead of a proprietorship or a corporation or a partnership, because it has like all the benefits without the downsides of some of the others. So I just like S corporations better, maybe because I've had a lot of experience with them. So I'm most comfortable with those operating as an S corporation. But in any case, an S corporation is just a regular C corporation. Subchapter S just allows you to be treated similarly to a partnership, but still keeping the corporate liability limitations. So it's the best of all worlds, in my opinion. And so I usually suggest, I've had a lot of clients that have been small business. I've never done tax for publicly traded companies which have lots of shareholders. So there's never been a reason why S election wasn't a great idea to me. But there are some reasons that C corps would be better. And we'll take another chapter in the future in a few weeks and talk about the differences in the different entities and how some businesses really might be better off working as something else. But for a lot of the ones I have worked with, S corporations have been the ideal selection. And so if it's a small corporation, not very many shareholders, it works out well. But here's the requirements you have to have in order to be doing an S election on your C Corp so that you can be treated as an S corporation, also known as a small business corporation. You have to have 100 or fewer shareholders. So the whole family would be counted as one shareholder. So it's like that related party thing where they group them together. But in any case, I have never been into that either. I would probably not push it just in case you got challenged by IRS and it voided your S election. But if you were in a pinch and you needed to have more than 100 shareholders and you had some family members, then I would definitely argue for that related party treatment so that you could join the family ones as just one. But as a rule, I wouldn't push it if I didn't have to. And then the shareholders, they can be U.S., they have to be U.S. citizens if they're individuals or residents. They cannot be what's called a resident alien. And so that's just a term used by the immigration services of the U.S. But in any case, they have to be a U.S. citizen or at least not a resident alien if they're an individual. And then an estate could be a partner, or I'm sorry, a shareholder in an S corp, and a tax exempt organization could be a shareholder in an S corporation, and so could a trust. But there's got to be just one class of stock, so you couldn't have any preferred stock and common. You just have to have common stock. And it has to be a domestic corporation. And for some reason, this got separated from itself. Let me put you back where you belong. And it has to specifically not be ineligible, because there are some circumstances that are rare, but there are some other things that could make a shareholder or a small business corporation or make a small corporation not eligible. And so they talk about that some more at Code Section 1361B, but I'm not really digging in that. I've never actually seen one that didn't qualify unless it didn't qualify for one of these reasons here. When you want to do the S election, you use Form 2553, and it just leads you through all these different questions that determine whether you meet these criteria that we just mentioned. Okay, and then effective date, once you do the election, if you file your 2553 form before March 15th, if it's a calendar year, then it would be effective for that very year. But if it's filed after March 15th, then it would be effective for the next year. And then it's the other thing that could preclude it from being effective, even though the form was filed, is if all the shareholders had not signed a consent. So they must have consent from every shareholder in order for it to be effective. And if you happen to get some of the signatures late, like after the 3rd month, 15th day, then that would make it effective for the next year as well. Okay, and then once an election is made and accepted, it is in effect unless it is voided or revoked So if a SC election is revoked, it could be voluntary. Like the shareholders just decided this was not the way they wanted to operate the business. And so they could, by 50% or more consent, sign the paper and revoke their SC election. And then the other thing they could do would be the other thing that could happen to void the S election is that something could go wrong and they had a involuntary revocation. And so that would be like if something happened that they no longer meet the requirements that they used to get their S election approved, like if they wind up taking on more shareholders and they're over 100 now, that would automatically void their S election. And then if they have too much passive investment income. So later on in these notes, we'll talk about this tax that they charge you for passive investment income. But just one time, if you had passive investment income that exceeded 25% of your other income, the other gross receipts, then that would be a tax they would assess, but it wouldn't void your election. But if it happened 3 years in a row, that would void your S election, because then you would be more of a passive investment company. And so they have a rule that says that doesn't qualify. And then if you ever have your S election voided, either voluntarily or involuntarily, then you can reinstate it and apply again, but you have to wait 5 years to do so. So you can't apply again for an S election after it's been revoked unless you wait till the 5th year. And then at the beginning of the 5th year, you can apply again. There's also some other exceptions about when they would let you reapply sooner, and that's at Code Section 1362G. And again, I don't see that very often in real life. And then S corporation operating issues, accounting methods and periods. Most of the time, S corporations are calendar year because I don't know that you can be on a fiscal year for S elections. I mean, for a S corporation, but I'm not certain about that. So if anybody wants to make a bonus point, go ahead and look that up for me and post it to the forum. But I've never seen one that was not a calendar year. Okay, and then the responsibility of the organization is just for the reporting for the corporation, not the individual shareholders. So they aren't responsible to track what's going on with the individual shareholders. They just the administration or the managers of the SCorp just report the income to the IRS, and then they show the income going out on a K-1, the distributive share to each shareholder, and then it's up to the individuals to determine how to tax everything after that. And then cash basis is okay for an S corporation if there's no inventory. The accrual basis is required for inventory-based operations, of course, because you can't show a deduction for the inventory you buy when you haven't sold it yet. But in any case, that's just logical. But income or loss allocation, whenever a shareholder comes in during the middle of the year or leaves in the middle of the year, that you have to prorate based on the number of days that the shares were held. And so there's a good example of this on page 1513. This is example 16, and they show you, and we'll work a problem about that on another video. But basically, it's like a partnership from the standpoint that it has ordinary business income and loss reported as a one-liner as taxable income or ordinary income from the S corporation, and then there'll be separately stated items. And again, I just pulled a few of them out. These are very common items that show up as one-liners on the Schedule K that also flows out, of course, to the K-1. And they're the same ones that we would see mostly, not all the same ones, but a lot of the ones that would be in the partnership K-1. And so that would be interest income, tax-exempt income, net rental real estate income, charitable contributions, Section 179, the investment interest expense and the investment interest income. Won't be any self-employment taxability, so there's not going to be self-employment tax reported on this K-1. And then there are a lot of others, but these are just a few examples of what shows up on the K-1 and the most prevalent ones that I've seen. All right, then the QBI is applicable to S corporations, but it is applied at the individual level. As you know, we've already talked about this as individual taxation, and then again at corporate taxation. No, we talked about this at the individual. We may have talked about it at the partnership, but I'm not sure. But the flow through would come through a partnership or an S corporation as well as individuals. But basically, it's a deduction that individuals can take as an from AGI deduction, and it's 20% of the lesser of either the qualified business income or the modified taxable. And QBI does not include cap gains and interest income, dividend income, that portfolio type stuff. And so it is subject to limits that include that modified taxable income limitation and a high income taxpayer limitation, that is the high income taxpayer limitation, but it's also capped based on 50% of W-2 wages and as one determiner, and then also capped based on a combo of 25% of the W-2 wages and 2.5% of the basis in depreciable property. So we worked through this some, but we aren't taking this really deep because this subject is extremely complex if you get into all the nuances. And so we're just trying to get an overview of QBI, knowing that it's going to affect a lot of taxpayers. And so you do need to understand it, but you just wait until you see your particular company's scenario to see if you have a complication that's going to require you to dig a little deeper. And then you go find the worksheets and work through each of the details to see where's the limitations going to hit you. But basically, these are the limitations. You take your business income and you compare that to your W-2 wages, half of them, and then you compare that to 25% of your W-2 wages plus 2.5% of your depreciable basis, and the lower of those is going to be where your limit is. All right, then the taxability of cash and non-cash distributions from the S Corp is one of the issues we have to learn about when we deal with S corporations. And so a cash distribution from an S corporation is very straightforward normally. If they never were a C corporation and they aren't associated with some kind of merge between a C corporation and S corporation, then that means the order of their distributions would just be it's non-taxable up to their basis. And then anything in excess of basis is a capital gain distribution. And so very straightforward. If they were at one time a C corporation and they converted to an S or they merged with a C corporation, then the ordering is slightly different. These two steps we already said about the ordering are still there, but they first have to have three other steps. So if you were ever a C corporation, you would have that business would have a AAA account, accumulated adjustments account. It would have an AEP account, which was the accumulated E&P that was coming in from the C Corp. And then it would have another adjustments account that was coming in from the C Corp. All three of these accounts would have been coming with you as you come into the S Corp from a C Corp. And so if you have those three, then a distribution of cash would be first considered to be tax-free up to the AAA account. Then it would be taxed as a dividend up to the earnings and profits that had accumulated, which is what they call, for purposes of S corporation, they call AEP, accumulated earnings and profit. And then it would be tax-free up to the other adjustments account. And then it would double back to non-taxable up to the shareholder basis. And if anything, any distribution exceeded all four of those, it would be a capital gain distribution. So, whew. But thankfully, we don't have to deal with that very often, because very few times will you see an S corporation that started out being a C corporation. It certainly happens, and I have seen them, but it's not like very, very common. A lot of times an S corporation is elected from day one of the corporation, and it's never operated as a C. And then non-cash distributions coming through an S corporation. There's a little nuance here. If there's a gain that would have happened because the property's appreciated over the book value, then that means it's treated as if it's sold to the shareholder. Sold to the shareholder for its fair market value. So that would produce a gain at the corporate level that would pass through on that K1. And then the asset that was received by the shareholder would be getting a stepped up basis to the fair market value, because the taxability had just happened at the corporate level and passed through to the shareholders. And then the flip side that makes the complication is if it is a depreciated property, in other words, there would have been a loss if it had been sold at fair market value because the book value is lower than its current fair market value, then the loss is not taken. There is no pass through of the loss. It is postponed until the stock would be sold eventually. So assets get a step down in basis. And that's how you accomplish pass through of the loss, basically, because you step down the basis of the stock, and that accomplishes a lower that gives you a lower basis. I'm gonna have to work on that one. The textbook said we have a step down in basis when it's distributed. So then when it was sold, it would be a larger gain. That's what it would be. Okay, so yeah, that's right. And then shareholder basis as you go along is very much like the partnership shareholder basis. You start with your adjusted tax basis that you bought the stock for, and your adjusted tax basis in the first year is that amount you bought the stock for, which is called the initial basis. And then adjusted would be as you go along and you add or subtract different things. And so adding, of course, would be if you put more money into the business, additional cash contributions, that would be additional basis. If you had income that was taxed to you as a pass-through and the separately stated pass-throughs, those would increase your basis. Then the shareholders' tax share of the tax-exempt income would increase your basis. And then decreases in the basis would be cash distributions that the business gave the shareholders back. Then the shareholders' share of any losses and separately stated expenses or losses, and the shareholders' share of non-deductible expenses. So when it comes right down to it, adjusted basis can never go into the negative. So if you wind up with losses in excess of your basis, that loss is going to be suspended and under the tax basis laws. So you know how we have the passive rules we've already been through multiple times for individuals, for partnerships, but just for the partnerships recently, we talked about the fact that you have your tax basis limitation. And then that's what we just talked about. The shareholders basis in the SCorp stock is the limit on how much any losses could be. Then at risk amounts, if you're not at risk on something, you can't take a loss on it. If you signed the line for a note at the bank, personally, that related to the SCorp, that would give you more at-risk basis, but it would not increase your tax basis. So it still wouldn't necessarily fix your problem. So it's the same sequence of events of tests that we go through, that we test to see, do we have tax basis? If not, no deduction. And then do we have at-risk limits? Do we have at-risk basis? Yes, if we do, then whatever tax basis allowed us to take, we can take. And then if we pass both of those and we still have some apparent loss, then we have to go through the passive loss limitations and see, is this an active activity or is it passive? If it's passive, it can only offset passive income, just like for individuals, just like for corporations, just like just like individuals and just like partnerships. The same thing for the S corporations. And then on top of all that, there's an additional loss limitation, which is the excess business loss limitation. So if your loss from your S corporation exceeds $540,000 for a married filing joint or $270,000 for other taxpayers, it also is limited. It cannot offset non-business income any more than $270,000, even if you had tax basis and you had at-risk limitation, at-risk basis and passive loss to offset it with. You still can't offset more than $270,000 for individuals or $540,000 for a married couple. So lots of limitations on losses. Okay, for S corporations, the corporation normally does not pay tax. They file a return and they pass through all the income to the shareholders. But there are a couple of exceptions where the corporation does pay tax for these several things. And a lot of them relate to, I guess maybe all of them relate to converting from a C corporation into an S corporation, that means there's still going to be some taxability while these things transition between the way it was treated on the C corp to the way it should be treated on the S corp. So here's one: built-in gains. When you have a C corp that converts to an S corp and they have property that had been appreciated and had never been taxed, then when it's converted to the S corporation, that means there's a built-in gain. And so there is a built-in gain tax that arises because of that. And then similarly, if you have LIFO, there's a LIFO recapture tax that's applicable to C corporations that use LIFO, and then they convert over to S corporations. So they're having to, like, I think it's a 4-year period, they have to spread the LIFO, the difference between LIFO and FIFO over that 4-year period to recapture how much should have been reported if they use the other method. So that's another add-in that causes a tax at the corporate level for S corporations. And then there's the other one is the excess net passive income tax. I mentioned this earlier when I was talking about the fact that 3 years worth of this can disqualify your S election. And so this is just where each year you look at it, and it's going to be whenever only on the corporations that were C corporations that converted to S. And if they have accumulated E and P, the tax is assessed when their passive investment income is greater than 25% of the total gross income. So these don't appear on most S corporation returns. But again, when you have that C corporation operating and it's rocking along and you change the status to S corporation and make that election, then you have to watch out for these taxes that could arise on the S corporation return. All right. And then filing requirements, the estimated tax payments would be due for a S corporation only if they actually had tax that was going to be due. So if it was one of these converted C corps that went into an S corp, they might have to pay estimates, but very few others. I can't think of a reason, and there might be some, but I just don't get it off the top of my head, because most of the ones I've seen that where they pay tax at the corporate level for S corporations has been related to this C corp conversion. And so if you have the C corp conversion, you probably do need estimates. But if you don't, you probably don't need estimates, because all the tax is going to fall on the individuals for most S corporation operations. Okay, so the form that we use for an S corporation annual filing is an 1120S. So a corporation files an 1120, as you know, and an S on the end of it is just the form for the pass-through entity. That's a corporation, S corporation. And it's sometimes called subchapter S corporation. And then the due date is March 15th for a calendar year, but any other year end for just like corporations would have been the 3rd month, 15th day. And then if you need an extension of time to file, it is an automatic, but the form must be completed in order to get that automatic. You don't have to prove you deserve an extension, but you do have to complete the form before the due date in order to be given that automatic extension. The form is form 7004. Okay, so that's all, kind of short and sweet on S corporations, but very useful tool.